Kathryn Rooney Vera here, Chief Market Strategist at StoneX, and it's a pleasure to join you today on this exciting Tuesday morning when we have the 10-year and 30-year yields flying the 30 years at the highest level since 2007. So a lot to talk about today. It's my pleasure to welcome Jon Hilsenrath, a friend and colleague who's been with us at StoneX now for what, Jon, 3 years going on?
2 years, a little over 2 years.
Fantastic, wonderful. Yeah, you just followed me, so I'm at 3 years on the button. All right, so let's kick it off. As I said, Jon, we have a lot of market movement. It seems like today, a lot of people might view today as a stock market conversation, but I think it's a bond market conversation. We are looking at a yield level which is showing extreme, a repricing of risks that we haven't yet seen, and the highest level since 2007. We've seen a whole generation, Jon, of portfolio construction built around the idea that when growth risk rises, bonds rally and protect portfolios. Today, the market is looking at something different. We're looking at an energy-driven inflation shock. We've got heavy fiscal supply. We've got sticky inflation. We've got a long end that is demanding more term premium. I think we got that right. I'll give ourselves a pat on the back. That was our bear steepener call that we've held since the beginning of the year, has done very well. But in this world, Jon, duration is not automatically the hedge. I'm going to look at investment strategy a little bit further in our conversation, so I won't jump the gun right now, but I do think it's a good time to start to look at duration. So the second statistic, just to kind of wrap things up in terms of an intro, is the consumer. We have April CPI. It was up 3.8%. Energy was up almost 18% from a year ago. No surprise to no one. And gas was up more than 28%. So almost 30% for gas at the pump. Retail sales are still positive, but those are nominal numbers. They're not inflation adjusted number. Payrolls rose more than 110,000, something like that. And unemployment held at 4.3%. So it's not a consumer collapse story yet, but it seems to me, Jon, like a consumer squeeze, a consumer compression story, let's call it that. Households are still spending, but more of the spending is being absorbed by basic stuff. We're talking gas, food, home, and other, basic necessities like clothing. So kind of with that preface, Jon, I'll just kind of bring you into the conversation and hear what you're seeing with regard to where we stand in the global economy. And then, Jon, we can just kind of bat it around. I'll ask you a couple questions, you ask me, and we can take it from there. Thanks. Go ahead, Jon.
Yeah. And I should also say, welcome to everyone who's listening. And if you want to join the conversation, Kathryn and I always love to do this in interactive ways. So if we're in a position where we can take questions, I welcome them. Kathryn, anyone who's been listening to us have these conversations over the last year or two would know that, I see, and I think you see, I don't want to speak for you, this repricing in bond markets as long overdue. We live in a world today of elevated inflation. I've been highly suspicious for months about the Federal Reserve's hope and expectation that the tariff shocks and then the oil price shocks were one-time transitory events. I started the year saying I expected inflation in the neighborhood of 3%, perhaps higher, because there's so much stimulus in the system, so much fiscal stimulus, budget deficits around 6% of GDP. What I think is a Fed funds rate, which is already set below a neutral level, and the inflation outlook since the Iran war has deteriorated. My expectation now is that we're going to finish the year with the headline PCE number closer to 4% than 3%. And core PCE, or a mean or a median, or whatever the new Fed chairman, Kevin Warsh, wants to look at. We could obviously talk some more about Kevin. I think the core is going to be above 3% too. So fundamental to what's going on in bond markets is the market is repricing inflation and the Fed. So if you look at a 2-year Treasury note, 2-year Treasuries indicated that the market expected the Fed to cut rates at least 1 or 2 times over the next couple of years before the Iran war. And now, if you look at a 2-year Treasury note over 4%, it's pricing in at least one Fed rate increase. And I think that sounds right. You talked about stocks and bonds. I think we're living fundamentally in a new era. And as a result of that, old correlations between stocks and bonds and the reactions to economic news have changed. I think we lived through a period of what we called secular stagnation, which was a period of very low inflation, which was tied to globalization. I think we're in a different era now where we're restraining the forces of globalization, which causes inflation. And we're also still pumping all kinds of fiscal stimulus, which was potentially appropriate during the stagnation days, which is no longer appropriate. And to me, that adds up to inflation. Very, very quickly, I'll talk about Kevin Warsh. He got the job, I think, because the president believed he was likely to follow his expectation, his demand for a lower interest rate. I don't think Kevin is going to be able to deliver on that. And I think the market is right. The market is effectively saying that the new Fed chairman, Kevin Warsh, is going to defy the president's wishes and not deliver an interest rate cut and may even raise interest rates over the next year. I think that's a distinct possibility. In fact, the market says the odds are more than 50%. And I have to agree that's right, because I don't think inflation is coming back down anytime soon.
One of the things that the proponents in the camp of rate cuts have been pointing to be able to cut rates has been AI. So, AI can be looked at from the framework of absorbing inflation over time.
Mm-hmm.
One
Right.
of the things that I've been talking about for some time is the lack of adoption whole scale to be able to really usher in the levels of productivity required to absorb inflation to the extent necessary to get to the 2% target. But I always like to look back to the markets, and just as our chief market strategist, I like to look at the equity market and the bond market. What are they telling us about AI? And despite the equity markets, both Dow and S&P being down today almost 1%, the truth is that the equity markets have been remarkably resilient, Teflon markets that have largely ignored anything in the pipeline that comes to try to bat them away. So I don't think it's that the equity market is ignoring macro risk. When you look at corporate profits, they've been remarkable.
Yeah.
It's
Yeah.
being held together by primarily what I talked about, AI-related earnings revisions. And
Mm-hmm.
that's different from saying the whole market is healthy. What we're saying is AI has become the bridge, essentially, between micro and macro. It's driving earnings. It's driving CapEx. It's driving power demand. There's the issue of bottlenecks and infrastructure that can keep pace with that, but that's a separate story. It's driving credit demand. It's driving index concentration to levels that we haven't seen in some time. We're looking at semiconductors, which about a decade ago were 2%, now they're 18% of the S&P. So there is a concentration risk here, and we have to separate the good from the risk. The good is that AI demand is producing real revenue, margin outcomes over time should dampen inflation. We saw Micron, Jon, and TSMC. They're not conceptual stories. The risk, as I see it, is that the AI trade is now embedded across portfolios under different labels. You have IWD holdings, show Micron, Alphabet, Amazon, all these AI adjacent names, really with positioning across ETFs. So people are massively overweight from passive investing. And I think the portfolio risk is not owning AI. The portfolio mistake is owning the same AI factor 5 times, right? And calling that diversification. Mm-hmm. So just to kind of finish, I think the key distinction, Jon, if we're thinking about this from a perspective of risk reward and portfolio allocation, which is what our clients are really keen on. I think we need to prefer, in terms of market strategies, AI beneficiaries, but not the played out stories that are massively over-owned, overvalued. AI beneficiaries with visible free cash flow and pricing power over those capital intensive stocks or capital intensive names that depend on cheap funding or
Yeah.
stable power costs or aggressive hyperscaler capex. So, John, what do you think? Could AI
Yeah.
capex be the thing that delays the slowdown? Do you
Yeah.
think it could
So
also
let
make
me,
the
there's,
economy more sensitive to rates and power costs?
so you touched on a lot of really important points there, and I think they're all really important parts of a complicated puzzle right now.
Right.
First of all, on this issue of valuation and AI, and why is the stock market going, why has the stock market been resilient when bonds are repricing? When I think about the principles of equity valuation, it's cash flow and the cost of capital, right? And I think what you're talking about is that cash flow is strong right now, which makes perfect sense to me. Nominal GDP growth, if you look at inflation near 4% and output growing on a real basis of around 2%, we've got nominal growth going at something like 6%. This economy on a nominal basis is running pretty strong. There's no signs of a downturn or a slowdown. So with nominal growth going as fast as it is, cash flow is doing really well, and there is a lot of money pouring into investment. On the other side of that valuation model, we now have the headwind of a repricing of the inflation risk and term premia, and so the cost of capital is rising. So I think that the cash flow driver has been very strong, but it's potentially running into some headwinds with the repricing of risk and inflation risk. On the issue of AI and productivity, a couple of points. I think we have had a productivity upturn, and it actually dates back to around 2017, 2018. We have seen the productivity numbers rise. This was all before AI. We're only at the very beginning of the adoption of AI. But we had mobile technology. We had the ability to work from home. We had, image scanning and voice recognition. We've had so much technological advance over the last decade that has been adopted by many corporations. And I think that did help, that has helped to drive American labor productivity. And I think AI is going to accelerate all of that. I mean, the conversations I'm having with Claude these days are just absolutely amazing. The analysis that it's letting me do. So I think AI is going to intensify these trends. We've learned something from the technological advance that we've already been through. I'm especially interested in what happened with the internet in the early 2000s. What we saw is a lot of churn in the labor market, which we're getting, rising spells of long-term unemployment, and new casts of winners and losers, old models failing and new models winning. So I think we're perhaps entering a period where stock picking, intelligent stock picking, as opposed to index tracking, is potentially a lucrative avenue. Having said all of this about productivity and AI, I do not think we are returning to a 1990s kind of episode, which is what the Trump administration and Kevin Warsh have talked about. Yes, productivity is advancing. Yes, that has disinflationary effects. That's all good news. At the same time, in the 1990s, globalization was advancing. We were going into a period of hyper-globalization where China, with a massive labor force of hundreds of millions of low-wage workers, were entering the global labor force for the first time. We had budget surpluses. We had a peace dividend. None of those factors are now in place. And so I think there are inflationary impulses we're going to get today that we didn't get in the 1990s, the early 2000s, which have to be a factor in any stock investor's consideration of how they're managing their portfolios.
Yeah, how they're managing their portfolios, that's a clutch distinction that you make between today and 20 years ago. And the market is effectively, John, trying to price three forces at once, right? Long end treasury repricing, real AI earnings momentum. It's very real and it's very positive. And as we wrote in a piece last week, a reemerging China surplus savings glut dynamic. Those
Yeah,
forces can coexist for some time, but they create it's but the macro distortions in the background don't go away. So it's not just a rates conversation. It's not just an AI conversation. It's not just a Fed conversation. It's a market trying to price AI driven earnings resiliency, which has been impressive, against sticky inflation with upside risk to both supply and demand inflation, I would argue,
yep,
fiscal
yep, yeah,
profligacy, and term premium shock. And
yep,
equities are still being supported by earnings concentration, AI capex, and the bond market is questioning whether long duration assets deserve a higher risk premium. And I think you would agree with me. They probably do. And for the past year, you and I have been saying, at least I won't speak for you, but in meetings with our institutional clients across the globe, I've been saying the 10-year treasury should be trading at 5. It's just
yeah,
not, because it's being dampened by a lot of forces,
yeah,
and one of which is structural in nature. And
yeah,
that's the China surplus savings. So I'll
yep,
I'll I'll throw the ball to you, John, and the equity market is saying earnings can carry the story. The bond market is saying inflation, fiscal supply, and term premium are no longer noise. They're a real concern. Which market is giving the clearer signal? And can you walk us through your view with regard to the excess current account surplus, the excess savings in China, and how that could be impacting to some extent the repression in rates? I mean, of course, rates have moved higher, but they could
yeah.
be higher yet still.
Right. All right. So let me make a couple of points. First of all, I'll add to the risks and the cross currents that you just mentioned. The other elephant in the room, which is geopolitical risk in Iran, and also in U.S. economic policy, U.S. trade policy, which is another unknown that seems to take on kind of new character, new texture every day. On your question of which market is giving us a fuller picture, it used to be back in the days when I was at the Journal, we often looked at credit markets as being kind of a little more attuned to macro developments than equity markets. But I think credit markets have been off for the last year in how
I
they
agree.
price the Fed and how they price inflation and long-term risk. So, I think the credit market has a real repricing that it has to go to. I have been so puzzled by why long-term treasury yields were, 4%, 10-year treasury yields were 4% when inflation was 3% plus.
Mm-hmm.
That factors in, kind of a negative real Fed funds rate. And I think that one of the stories that I've come to is this mini global saving glut that you just talked about, which is that,
Mm-hmm.
you know, China in the early 2000s ran trade surpluses of $300 billion plus. And Ben Bernanke came up with this idea of a global saving glut to help explain why long-term treasury yields were being repressed even when the Fed was raising rates in the early 2000s. That there was just a lot of excess savings around the world that were being recycled into US dollar assets, in particular treasury and mortgage debt. We know what we got out of that. We got a housing bubble. China's trade surplus today is in excess of $700 billion.
Mm-hmm.
Now, it's being driven by a different set of factors. In the early 2000s, there was this massive influx of very cheap labor that allowed them to sell really cheap stuff all over the world. What they have now is excess supply and not a new influx of cheap labor. And so they're exporting their own internal domestic deflation to the rest of the world. Now, one of the challenges for the United States is because we put up barriers to Chinese trade, we're not getting goods deflation. We've had goods inflation over the last year, in part because of our tariff policy. So it's hitting other countries, but this glut of global savings, I think, has helped to hold down U.S. Treasury yields. But I think that dam has started to break, which leads me to my final point. In this kind of environment with geopolitical risk and inflation risk and such, to me, like there's the twofold investment strategies that I think make most sense are global diversification. So there's the risk, I think that investors, emerging markets right now, we're seeing them come back. We're seeing, because of the Chinese surplus, the Chinese yuan appreciating. It's already appreciated 7% in the last year. There's probably more to go. We're seeing countries, not just the United States, ramping up on the AI boom, but Korea has been on absolute fire for the last year. So I think global diversification is one important leg of the stool. But then I also think, intelligent, I think the American investor has gotten so comfortable with index tracking and putting all their eggs into that basket. And, I think smart stock picking has the potential to do really well, because we now live in a period of extreme disruption where business models are going to get destroyed overnight by AI. And if you could pick the winners in that in that scenario, but also highlight the losers, you have the potential, I think, to really outperform indices. But you got to be smart about the long short positions that you take.
Right. And there's a lot of guys calling this an AI bubble. I don't agree with that. This is not a simple AI bubble. AI earnings are positive, but the factor has become embedded across portfolios and has become increasingly sensitive to rates, power costs, capex financing. So the AI thesis, in my view, Jon, can be fundamentally correct, and I think it is, and still create portfolio construction risk. That's my bottom line, because we are overexposed to it because it's embedded in so many different areas. The risk, I think, is, even if you look at value portfolios, they're not clean diversifiers. Even the treasury market, as we said at the beginning, is not a diversifier. It's really hard at this point to find diversification to offset any potential losses. And I think that the portfolio mistake, as I said before, is not owning AI. It's owning the same AI factor 5 times. I think that's something that guys have to be increasingly weary of. In fixed income, a 5+% long end yield becomes more interesting to me. But attractive yield and attractive risk reward aren't the same thing. So the better stance, I think, is conditional duration, carry, selectivity, and less spread beta. So we want to be selective and nibble at duration. The opportunity, I think, is there in fixed income. The opportunity is in yield, not spread compression, just going for the yield. Fixed income is if we look into the second half of this year, we have supply-driven shocks that are not going anywhere. We have elevated yields and changing correlations. All of that mean outcomes depend more on what the latest shock is in the pipeline, and duration is less reliable as a clean hedge. Now I'm thinking of it as kind of like a tactical money maker, not a hedge for your equity portfolio, not let me go long duration so I can hedge my, I can match my asset liabilities. So my outlook, I'm looking at income, carry, I'm looking at selectivity and tactical duration bets rather than broad. We can no longer, Jon, do this broad fixed income beta or equity beta, where everything that we throw a dart at does very well. So credit spreads are not paying much for generic risk. Yeah. That doesn't mean that we avoid all credit. It means we avoid lazy beta plays. They're going to lose. So we should favor stronger issuers, shorter or intermediate maturities, some long duration. Securitized credit looks attractive in my view.
Mm.
high quality carry. But we need to be more cautious on things like broad high yield, levered loans, maybe sub IG REITs. So these are areas where we're talking to institutional clients and discussing some of these opportunities. And I think you said recently pointed to Asian corporate credit,
Yep.
and that looks even. I'll pass you the word here, but I liked what you said. You know, you looked at Asian credit risk spreads versus U.S. credit risk, and you looked at internal ratings of both corresponding peers. And while U.S. spreads have stayed contained despite rising default risk,
Yeah.
Asian credit quality, excluding China property, of course, looks more attractive over weaker U.S. credit. So where would stress show up, Jon, in your view, first? If the 30-year keeps moving higher, would it come from credit, housing, private markets? Would it come from banks? Would it come from equity duration like tech? Where do you see it showing up?
Well, I mean, the market that I've been most concerned about, you talked about lazy beta,
Yes.
is U.S. Treasury market. And I think that has the potential to be enormously disruptive if this upturn continues, because of course it touches everything else,
Right.
every other piece of credit. So yeah, I'm most concerned about the U.S. Treasury market and the risk of disruption there. Especially because there are a lot of hedge funds, who provide a lot of liquidity to the U.S. Treasury market, and if that liquidity gets volatile, then who knows what happens. I want to say something else because you talked about the AI bubble. I just want to reflect on that a little bit and then come back to the Asian credit
Sure.
thing. So on the AI bubble, I'm going to be very unscientific here and talk a little bit about history and my own experiences writing about bubbles in the past, including the internet bubble back in the late 1990s and the housing bubble in the 2000s, and the Asian bubble in the 90s. These were all booms and busts that I followed. One thing to recognize about bubbles is it very often is the case that asset bubbles are attached to technological advances. I've spent a lot of time looking at the history. So we got asset and financial bubbles in the US banking system in the 1800s surrounding canal stocks and railroad stocks after the Erie Canal was created and basically transformed the Midwest when railroads connected the East to the West. We got these booms and busts around these innovations. Again, we got it around the internet in the early 1990s. So I think there is an obvious risk here, but and this is where it's like, for me, it's more just like touch. I don't feel that we're in the crescendo of this boom. I don't feel like we're there. You know how I felt the bubbles getting near a bursting point in the 90s and the 2000s. My very simple rule of thumb is when you go to a dinner party or a cocktail party and everyone is talking about how they want to get involved in this trade or that trade, whether it was Bitcoin a few years ago or internet stocks like when it infiltrates day-to-day talk at Starbucks or cocktail, then it's time that this thing is kind of running out of gas or it's in its last stages. I just don't feel like we're there, which gets me back to this nominal growth story and this liquidity story. There is a lot of growth in the global economy, nominal growth. There is a lot of liquidity because of U.S. budget deficits, global budget deficit. The Wall Street Journal has a really good story today about like fiscal imprudence is not just a U.S. story, it's a global story in advanced economies. So I think there's just a lot of money out there flowing, and I see that continuing to feed risk assets. Now, coming back to, you mentioned Asian credit. To me, the story about diversification, you've talked about kind of, credit versus equity. Diversification to me is no longer just about asset allocation between, between stocks and bonds. I think that's lazy beta, so to speak. I think it's global, and I think diversification is you have to be thinking about how do you diversify your portfolio globally, and also in asset classes beyond stocks and bonds into areas like commodities can otherwise, but especially global. To me, I've been and that's what brought me to looking at at Asian credit. You know, when you look at upgrades and downgrades in the Asian credit space, corporate, like Asian credit has been very stable from an upgrade downgrade perspective over the last few years, at a time when downgrades in the US and Europe have been rising, even as spreads have been contracting. So, like, to me, that's another sign where you might see some relative value if you look beyond the normal indicators.
Yeah, I agree, John. I think international does look attractive. I will say that EM has flown quite a bit. EM is not a blanket buy. A lot of US investors tend to lump EM into one basket because that's what the EEM does or the MB does, but it's not a blanket buy. It's a real yield trade. It's a dollar trade. It's an oil trade. It's a China trade. And I think increasingly it's an AI hardware trade. You cited Korea, I'll add Taiwan to that. They've done spectacularly, but they too, I'll go back to my initial point, is that diversification is not in fact diversification, because what you're buying is more tech. Okay, so it's not diversification. EM can look diversified on an asset allocation page and still trade like the XLK. Taiwan, Korea, memory, foundry, AI hardware, all of that is embedded. So I think if we look at, there's a lot of interest with regard to China. So a lot of real money accounts were bullish on China. China's not a bullish story. April data showed weak domestic demand, retail sales paltry, industrial output not great, 4%, fixed asset investment down, and exports and AI-linked electronics remain the bright spots. So again, we're talking about AI, we're talking about tech. So it's not a broad China reflation story. And in the piece that you and I collaborated on last week, we talk about that, how the appreciation, almost 10% of the yuan, is not because China's a great story. It's because of these balance of payments dynamics. China is a weak household demand story, incorporating strong export and electronics. So China's no longer one macro story. In my view, it's a weak domestic demand story plus deep pockets tied to exports, deep pockets tied to electronics. And the dollar point, I think, is clutch. It's more complicated than I've looked at in some time. If US yields rise because growth is improving, then the dollar can behave like a growth safe haven asset. If yields rise because what they're doing now, because of fiscal supply, inflation, term premia, the dollar's a less clean trade. That's why gold strength, commodity strength, and dollar, and let's call it ambiguity, can and do simultaneously coexist. So I do think there are opportunities in emerging markets. I prefer Latin America. It's done very, very well. I like Brazil. I've liked Mexico. I'm going to Mexico actually next week, so I'll have more color for everybody then. But I think there are opportunities in real yields in some of these spaces. But I think we need to look beyond just the pale of, okay, let's go into emerging markets. I do like the dollar story as well, John, because if we are expecting things to resolve, the market is saying, essentially pricing in a soft landing, then now's the time to invest in international. Now's the time to invest in international. And I think the core portfolio point is that we have to look at different buckets. We have to look at growth. We have to diversify in terms of not just asset classes, but diversify, John, in terms of shocks. What are the asset classes that benefit from this shock? Granted, there could be black swans, but I want to be positioned, and I want to advise our real money and hot money accounts to be diversified in asset classes that do well with a growth shock or a commodity shock or a dollar shock. And diversifying in that way, I think, is going to be the best way to tackle the next, I would call it 5 to 10 years, where structurally things are changing.
Yeah, I think it also just it helps to form coherent views about winners and losers, and you know, and who's going to come out of this AI revolution bigger and stronger. But Kathryn, I want to ask you, since like this is my area of concentration. Maybe we could talk a little bit about the Fed. I know that's on a lot of people's minds. I know, you know, we're going through a leadership change with Kevin Warsh becoming the chair, Jay Powell walking out the door. Kevin Warsh's first meeting is coming up in June. Maybe we could talk a little bit about that. And then I also want to ask you, that painting behind you is just absolutely beautiful. I would love to know the story behind that.
Hey, John, do you want to know the fun story about that? It's a television. You like I go on television quite a bit, so you know that nowadays what they do is they put TV screens behind you with ultra high definition. This is that. So this is actually
Wow.
television, and I'll tell you one thing. I can change it per your pleasure, John. So,
Well, I want to go back to the blue flower garden. That to
all
me,
right,
that was
let's go
just
back to the
spectacular.
let's
And
go
it
back
really does
to
look
the
like a
Monet.
painting.
This
It
is a
looks like a
Monet.
Monet.
So
All
yeah,
right.
let me just
I want to hear, like, I could talk about the Fed. I want to hear, like, when you're thinking through, like, where rates are going, what do you know, and you were saying months, you were asking the question months ago, what are the chances that the Fed raises rates this year when
yes.
nobody thought that that was a serious question even? And
Yeah.
now, like, yeah, it's a real possibility
Thanks for the
that,
shout out, because earlier this year I was in fact saying that, and you and I were discussing it, John, which is if we get a combination, in my view, this is my logic. And I think some of these things have played out, some have not. But my intuition said we're not going into recession. I wasn't a believer in stagflation. I still am not in that camp. I think that if the US grows at potential, at trend, potential, maybe above potential, so we avoid a big slowdown, let's call it that. We avoid a recession. Um, the markets continue to post pretty good earnings. We have the wealth effect. We don't have an unemployment rate that has even come close to what I estimate the neighborhood to be, which is about 5%. Plus, we have supply and demand inflationary shocks, because demand, from everything that I just said, including fiscal profligacy, all of that foments demand. But then you have supply shocks coming from not just oil prices, but another thing that I've been quite ahead on from my March 3rd piece publication was fertilizer. So we should expect, John, to have food prices jump at the grocery store in, let's call it 6 to 9 months, because there's a lag. So
yeah.
coming up next year, my suspicion is that we are going to have rate hikes. I don't think they come this year. I think they come next year. But this is why, and just to kind of close out on my top trade ideas, as you mentioned, to have clarity around this, the areas I'm constructive with are inflation protection, tips, break evens, CPI linked trades, selected real assets, ag inputs. One of the big, I can't say the specific name, but one of the fertilizer names that we talked about early on has gone up about 50%. Defense and security beneficiaries, gold, commodity exporting emerging markets. I also like Hong Kong equities. And in the last piece on page 9, we have a strategy table, and that highlights all of my top calls across asset classes. So long CNH exposure, payer swaptions, bear steepeners, Asian IG credit, real assets, as I mentioned, and selective reduction of US equity duration. I'm talking about tech. So all of that can be found on page 9 of the piece that we published last week. So
I'm super curious about Hong Kong equities too. I want to talk a little bit about the Fed from my perspective. You know, there's a narrative here that's played out over the last year that I think is worth getting under to try to understand where the Fed is going next. So there were a lot of concerns last year around this time when the race to succeed Jay Powell effectively started, about the central bank losing its independence. You know, a lot of talk about the president putting someone in charge of the Fed who's kind of loyal to his demand for a lower short-term interest rate, shaking up the Fed board, potentially shaking up the regional Fed bank system by moving some of the regional Fed bank presidents out. What's happened over the last, say, 6 months or so is and Kevin Warsh has said he wants regime change, right? What we've seen over the last 6 months is what I would call a narrative of the regime strikes back, right? In the sense that on many levels, the president tried to fire Lisa Cook. Lisa Cook refused to leave. She's still a voting member of the Fed board. It looks like the Supreme Court is going to side with her, which means that the president cannot fire a Fed board governor without clearly demonstrating some element of cause, which it doesn't look like he's done. So there's insulation there. That makes it harder for the president to fire regional bank presidents without a majority of loyal Fed board governors. Back in November, as the Fed was cutting interest rates, we started seeing more regional bank presidents speaking up, saying, wait a second, we might be going too far here. Since the beginning of the year, there's been this debate building inside the Fed. At every meeting, I've been following this. If you look at the minutes, you see it carefully. More and more people saying, wait a second, we've got to get rid of this easing bias that we have. We at least have to have a neutral bias. More people saying, well, it's possible we might have to raise interest rates. So we've been in this period where now it's all coming to a head. It's become clear that Kevin Warsh is not going to take over an institution that's ready to just bend to his will. And Kevin is the kind of guy who he's going to try to win over, I think, the regional bank presidents and the government.
What are the chances, Jon? What are the chances that we have, for the first time, if not mistaken, since Volcker, that we have a Fed chair dissent? I think it's close to zero, and maybe you're the Fed whisperer, but I would tend to push back on the idea that Kevin Warsh is hell-bent on rate cuts. I don't think that's true. I think that Kevin Warsh is actually, cares about his legacy and cares about doing a good job. So I don't think he's hell-bent on rate cuts. This isn't Steve Meyer.
So this is where, so in terms of where I think Kevin's heart is, which is important in reading these situations. How does this person think? How does he behave? What does his history suggest?
Yeah.
Kevin, one of my favorite anecdotes about Kevin is that he was voted in his high school yearbook teacher's pet. He wants to win people over. It is his nature to try to win people over. He won over the president, but now he's going to lead an institution. He's no longer the outside critic. He has to get people to follow him. The Fed has built a consensus-driven approach over the last 20 years. I don't think Kevin would dissent against his own group. I think he would end up trying to move the group as far as he could in his direction and then vote with the majority.
Yeah, sure.
But I think we will have more dissents in the future what's
the chance we're going to look like Bank of England, where we have like they have 6-4 and we get dissents. I mean, we're already moving 4 dissents. We've already moved in that historical anomalies, but they could become the norm.
Yeah. And I think we've already moved in that direction. So, Jay Powell had a very long succession of policy decisions with 0 dissents. And now we're getting, 3 and more. And I think we'll continue to see that. But I also, two final points. As we move into the end of the year after the midterms, if you're Kevin Warsh, you're looking at a president who put you in the job who's now a lame duck. And you're also looking at a court system that's kind of, and an institution that's established your independence as being imperative. And you're looking at markets that are saying, we don't think rate cuts are appropriate anymore. So I think it's all lining up for Kevin to, and Kevin has said over and over again, that independence isn't something you talk about, it's something you do. And so, I think we're potentially lining up towards a very interesting meeting in December, if the inflation outlook is what I say, and we're going to end the year close to 4%, they might be making those hard decisions at the end of the year, clearly with a bunch of dissents. Let me talk very quickly about June because it's interesting and it's coming up. There's Kevin Warsh has said he doesn't like the dot plot. He doesn't like the interest rate projections. I strongly suggest he hasn't had enough time to kill that, which he wants to do. So he's going to be in a position at his first meeting next month in just a few weeks. What does he do about the dot plot where he doesn't like it, but the institution isn't ready to kill it? I think what we're going to have is the Fed producing a summary of economic projections and interest rate projections, and the chair will not participate in that process. So we're going to have, instead of 19 dots in the dot plot, we're going to have 18. It's the case of the missing dot. My expectation is that the dot plot won't have Kevin's projection in it. And so we have Stephen Mirren, who is the governor who Kevin is replacing with a very low dot. That's going to disappear. If you take the dot plot seriously, the mean and the median is going to go up, in part because Mirren's very low dot disappears, but it's not going to be replaced by anything. And everything Kevin does between now and then will be to undermine the relevance of that in the first place. So there's going to be a lot of interesting intrigue around that dot plot. But I think the bottom line is that Kevin is going to give people is don't pay attention to that. Listen to what I say and watch what we do. Don't watch what these forecasts because he doesn't believe in what he calls forward guidance. So,
Right.
So the bigger picture here is, for people who like to obsess about the Fed, it's great. It's great water cooler talk. There's going to be, I think, a lot of people wringing their hands trying to understand, like, who is Kevin Warsh and what is he trying to do? And we're going to be spending the rest of the year, I think, trying to really figure the guy out. He's been dovish at times. He's been hawkish at times. He's given speeches that are a little obscure. He said he wants regime change, but hasn't fully defined what regime change looks at. From my perspective, my old journalistic juices are flowing because I think it's going to be a really interesting institution to watch with very big consequences for the markets.
Well, we're lucky to have you, Jon, because your ear is to the ground and you were known as the Fed whisperer, and to us, you continue to be so. So that all of your inside juice and, the juicy gossip and the talk around the cooler and palace intrigue is very, very well received by our client base. So
all you benchmark people out there, give us a call. We'll come give you the good stuff at the
there you go. There you go. My own personal view, I coincide with you. I think that there's maybe I'll just be a little direct. I think there's no rate cuts this year at all. I think there's a good chance of rate hikes next year. So the Fed is on indefinite hold from my perspective. So that answers the first question I think that we received from the audience. The second question is that the Treasury books, it's 261.5 million ounces of gold priced at 42.22 US dollar per ounce. At 4,600 today, it means 1.2 trillion of unrecognized assets sitting in the ledger. Do you think this is done on purpose to have some effect? Jon, do you have an answer to that?
You went through those numbers pretty quickly. What is it that we're talking about here?
Yeah, I'm not.
Oh, the gold holdings. They have all these assets.
Yes. So the question is that the Treasury. I'm gonna try to rephrase it. So essentially, it's saying that the Treasury books gold priced at $42 per ounce. Today, gold is at 4,600. So that means 1.2 trillion of unrecognized assets sitting in the ledger. Is this done on purpose to have some effect? That is the question.
I mean, the federal government has a lot of assets that aren't, kind of counted anywhere. There's all kinds of real estate assets. It's why, there were stories flowing around a couple of months ago that the federal government is technically bankrupt or delinquent because we have all these unfunded healthcare and Social Security liabilities. And I just don't think that you can do the accounting for the balance sheet of the federal government the way you would a bank or, or even a mining company. I think what really matters, you know, the core of finance is the cash flows, right? And the fact of the matter is, because inflation is rising and there is a lot of debt outstanding, the cost of funding that debt, the interest burden, is rising and crowding out. I think other areas of the federal budget, and leaving, frankly, the federal budget very little room to respond if there's another shock. So I think the Treasury and the federal government are constrained, and they're asking for trouble by not addressing uh, budget deficits that are running at 6%. This is a flow. It's not it's not a stock. Running at 6% of GDP is twice the norm for an economy running with an unemployment rate, a little bit over 4%. It's extraordinarily stimulative. I keep coming back to nominal growth. It's why we're running at nominal growth over 5% and inflation near 4%, and nominal growth is possibly 6%. It's in terms of the treasury portfolio. That's great. Yeah, okay, so we have a lot of gold and it's worth more, so what are they going to do? Are they going to sell it to in a crisis?
I
Maybe.
think I know what the question is getting at. So gold is priced at $42 because of some old law.
Yeah.
If you create a huge paper gain, there would be credibility issues. If Treasury suddenly marked gold from $42 to $4,600, it would look like they're trying to pull the wool over someone's eyes. It would look like they're trying to create money or ease fiscal pressure without issuing debt. So markets would likely read that not as an accounting change, but as some tectonic policy shift. So today we have high deficits. As Jon said, we have the necessity for more treasury supply. We have a Fed that can't cut. So that signal would be very risky. It would push term premium far higher, not lower. So they're going to leave it, I would venture a guess, untouched. Think of it like this. If gold is like, it's like a glass, like breaking glass. If everyone knows it's valuable, but the moment you break it, markets assume something is wrong. So, okay, they repriced their gold holdings. Something's really wrong here. And so I guess that would be my initial take. It ties
my only
to the
point,
broader
Kathryn,
framework. The system is already being held together by global capital flows and suppressed yields. If policymakers start unlocking hidden assets, it tells markets that the underlying balance is strained or that it's about to break. That's my take.
I don't want to belabor the point. I'll just say this, that like as everyone out there knows, especially anyone who's involved in running a financial institution, you could change your marks in the book. Okay, that doesn't really matter. What really matters is how you fund yourself and how those funding costs are changing, right? And the sustainability of your funding costs because of, whatever your cash flows are. And the fact of the matter is that, the federal government is funding itself with a lot of short-term debt, and a lot of debt for which the cost is rising because inflation is too high. So, okay, you could change the marks in the book. It doesn't matter. Watch the liability side. That's what, is what I've learned over the many years of watching financial institutions respond to stress. Watch the liability side. How is your short-term funding book holding up?
I think it's such an interesting question, though. Thank you for that question. And imagine if that occurred. Imagine if Treasury marked gold to market tomorrow. That would instantly create an enormous accounting gain. Like Treasury could issue new gold certificates to the Fed at a higher valuation, and they could, in theory, receive hundreds of billions in new liquidity or balance sheet capacity without issuing new debt.
Sell the gold to get the money. But let me say something else, which I think is more pertinent and relevant today, and I've seen signs of this coming out of the Treasury, and I've seen signs of a desire for it coming from Kevin Warsh.
Yeah.
The the Treasury has some incentive. The Treasury has been funding its budget deficits and the beta in its budget deficits at the short end of the yield curve. I think over the course of the next year or two, unless there's major disruptions in the bond market that it has to stabilize, I think we're going to be seeing the Treasury, and actually the pressure is increasing now because long-term yields are rising. I think we're going to see the Treasury moving issuance out of the long end, out of 10s and 30s, and towards the belly of the curve. A net downward adjustment in the average maturity of U.S. government debt. And I think this is something that they're going to try to do for two reasons. One is overall to reduce the maturity structure of the debt to lower the government's funding costs because of term premia, but also to give Kevin Warsh a little leeway to continue or increase the runoff of long-term Treasury debt that the Fed holds. Because Kevin doesn't want that on the Fed's balance sheet. He doesn't want the Fed to be holding so many long-term bonds. And I think the U.S. Treasury is going to try to accommodate that by altering its own issuance strategies. Kind of, you might call it a new Operation Twist. It's a story, keep your ears to the ground for it, that I think we're going to be talking about over the next, say, 6 to 18 months.
Yep, I agree, John. Well, right on the button, it is 12:01. We're 1 minute off, but we did start late, so we have that. So just as a takeaway for investors focused on rates, on equities, the market is not pricing one story, it's pricing two stories at the same time. We have the rate side. My base case, John's base case is no Fed cuts this year. I think the risk of rate hikes next year is higher than markets want to admit. I think inflation is still too sticky with both supply and demand inflation shocks in the pipeline. Fiscal supply was too large, and remains too large. And the long end of the Treasury bond curve is requiring more premia for that duration risk. So the Fed is not in a position right now to rescue markets. It's not in a position to cut rates. On the equity side, as I mentioned, the AI earnings story is legit. That doesn't mean riskless. The market is increasingly concentrated. I want to reiterate this, in a small group of companies across many funds, across many geographies that benefit from AI CapEx. And those companies are sensitive to several things. Discount rates, if they don't come down, that's not a good thing for them. Energy costs, infrastructure bottlenecks, and financing conditions. So all of those things are risky for the high flyers going into next year. So the question is not simply whether to own stocks or bonds. The question is whether portfolios are paid for the risk they're taking. Okay, I'm going to close it now. Thank you very much for joining. Please reach out to us with any questions. Thank you for participating. Goodbye.
Thank you.
Thanks, John.
Thanks, Kathryn.
I'm gonna